Well, welcome to April, and with that, spring is just around the corner, which means we're at the end of the first quarter of 2024. So we thought we'd reach out, touch base with everybody, and give them an update on what has happened in the first 3 months of this calendar year. It certainly has been positive and a good environment. I'm just going to share my screen here. Now we'll take a look at the numbers for the quarter. The TSX had a decent month and is up just under 10% year to date. The US market has a little bit stronger, the S&P 500 up 10, the NASDAQ up 10. But when you look at the trailing one-year numbers, it certainly has been solid in the US. Canada has lagged a little bit. But you go to outside of the US, outside of Canada, international, there really is some strong numbers. You've got Italy up roughly 32%. Japan is up over 40% in the last 12 months. And India is doing very well, up 33% as well. Crude remains strong. Natural gas certainly has been weak. Gold has found some life again. But when we look longer term, the interesting thing is when you kind of, now that we're past the first 3 months of the year, we start to wonder, what does the second quarter bring, the third and fourth quarters, as we look at the balance of the year. One of the interesting stats is a positive January generally leads to a positive year. Certainly indicated by this chart, and January was a positive month for us. One of the things that stands out to me is, markets are making new highs again. And one of the things is when markets start to make new highs, we tend to get a few more questions about what do we do when a market makes new high? And there's a tendency to become nervous when a market makes a new high. Well, if you go back and you look at the last 15 years for the S&P 500 index, it certainly has not been an easy ride. There is some certain volatility in the market. But as you look at this chart, starting from the bottom left corner, rising to the top right, if you would have sold anytime the market started to make a new high, you wouldn't have made any money in the market. There are lots of new highs that will be made in the markets as we go forward. So don't let that be something that stands out of concern to you. It's something we should be excited about. One of the other things in terms of valuation we like to look at is looking at what the 3-year rolling price returns have been. And one of the interesting things is the current 3-year, we're at the 3-year average, which is 29%. But never in the past 50 years has the market been in what we would call a bubble environment. Generally, for a bubble to happen, or when we look at this example, it's been 100% return in the previous 3 years. Back in 1987, it's the same thing in the dot-com bust, and as well as the financial crisis. But we still are being driven by the Magnificent Seven. And this is a great chart, kind of looking at 2023 year in review, and it continues this the first quarter as well. So in 2023, that basket of just 7 stocks in the S&P 500 index returned 76%, where the other 493 stocks that make up the index returned just 8 for a combined return of 24% last year. In the first quarter of this year, kind of year to date, the Magnificent Seven continues to lead, up 13%. The S&P 500, the balance, those other 493 stocks, up 6% for a combined return of 10%. So we ended last year on a very strong note. November and December was quite strong. The first quarter of this year has been quite strong. So it begs the question, what happens when we have back-to-back quarters of 10% returns? It's happened a number of times, back to 1954, 58. The most recently was all the way back to 2012. So it's been a while since that has happened. But historically, we get a little bit of weakness, kind of 1 to 2 months, maybe a little bit into 6 months. But 1 year later, it's been positive in every one of those instances. Also coming off a year in the US market that had gains of over 20%, what typically happens? Normally you start off with a little bit of weakness and the year gets a little bit stronger. further to what was just shown in the slide before. Now, obviously, this year has been a little bit different, so we'll see how it works out. This year has started quite strong, 10% gain in the first quarter. This continues to be one of my favorite slides, and I use it often. And really what it's about is there has never been a year where the market didn't have a negative point during the year. So far this year, the market's up 10%, and at the lowest point, we were down 2%, which is, if you go back to the 1980s, is certainly on the low end of negative performance at some point in time during the calendar year. So it begs the question when we're looking at this is, have we made the lows for the year and the rest of the year are going to remain stronger? We're in election year in the US. We certainly get lots of questions about what impacts that could have on portfolios. Again, we're a little bit different this year with a strong start to the year. Historically, in an election year, which happens every 4 years in the US, the first kind of quarter remains relatively quiet, and it gets strength throughout the year. We've had a very strong start to this year. And in this next slide, what I want to demonstrate is historically, when you look at election years going back, to the 1950s, they typically are amongst the lowest returning years. So 7.2% is the long-term average for an election year. Only midterm election years are lower. If you look at the 2 years that make up the 4-year election cycle that are non-election years, those are typically the strongest year. So based on history as a guide, we would expect that this to be a bit of a weaker year in terms of total performance. But as the chart on the right demonstrates is, as we get closer to the election, expect volatility to pick up in the markets. In terms of consumer confidence, that still bodes well for where we are in the market. We're still below the long-term average of roughly 85, kind of sitting in at 79.5. So there isn't exuberant confidence in the market right now. This following chart I find very interesting, particularly in the US and with the election just around the corner. This is consumer confidence by political affiliation. And so as you can see, Democrats are far more favorably disposed in confidence with the market than Republicans currently are. Certainly shows the divide between the two political parties south of the border. Another question we're getting lots of, what can we expect with interest rates? Historically, when markets do well when the last rate hike is done. And so the chart here, looking at the last rate, this is the red is the 22-23 cycle. So we're kind of tracking the first half. And as interest rates continue to come down, markets continue to generally get stronger as that happens. The night after the last rate hike in 1994, 1995, the market returned over 60%. After the last hike in the early 80s, it was over 50%. Same thing as 2015 and 18. 1988, 89 returned 30%. 04, 05 was relatively flat. It was only the 1999, 2000 after the last hike that actually was negative. And that was the tech bubble bursting. But this gives you a visual of what future interest rates are expected to happen. So at the end of kind of this year, rates are expected to start to go down. And when you get out 2 to 3 years, the Federal Open Market Committee, their long range projection is to be down to the 2.6% range. 2 years out or so, the market's looking for rates to be around the 3.6% in the US. Let's have a little look at market valuations. When we look at the US market, which is the most largest dominant market, at the end of March, they were trading at 21 times earnings, which is roughly a standard deviation above the long-term historic average of just under 20 times earnings. But I want to dig a little bit deeper into that. And that is looking at, again, we have the Magnificent Seven. If we expand it to the 10 largest stocks, that make up the S&P 500 in terms of their current valuation, they're at 28.5 times. The remaining 490 stocks are 18.3 is their current to get us to that 21 times earnings. So if you strip out the 10 largest stocks on the PE ratio, you can see that we're closer in line to what the long-term historic averages are. The top 10 stocks in the S&P 500 index represent over a third of the total market value of the S&P 500, while contributing just 25.5% in terms of earnings. Again, when I look over this is something we try our best to look at the direction of the market. We follow a lot of market pundits, but this just shows you that at the end of the day, nobody really knows. You go back to 2018 and you look at the median estimate and what they were looking for the market to return that calendar year versus what actually happened. Market pundits were looking for a 7.5% rate of return that year when the market actually returned 6.2%. So they overestimated the performance of the market, underestimated it from 2019 to 2021, overestimated it in 22, and underestimated it again in 2023. That's it for our quarterly update. We'd love to hear your feedback. It certainly was a strong quarter, and we'll see what the second quarter of 2024 brings for us. Thank you for your time. Thanks for watching. Please reach out to us should you have any questions.